Friends, welcome back to my YouTube channel. Today I am going to talk to you about some monetary tools which are the basic fundamentals of monetary policy. All liquidity is maneuvered by RBI with the help of those monetary tools. You may be aware that we have got various reserve ratios in the process and certain policy rates. So, practically, there are six monetary tools which the RBI is using while reviewing the monetary policy. First one is the repo rate, and the second one is the reverse repo rate. Reverse repo rate has been kept unchanged for a long period now at 3.35%, whereas other policy rates for last 5 monetary policy reviews have also been kept unchanged. Even yesterday, the policy rate have been kept unchanged. But yesterday, the GDP growth rate has been revised from 6.5% to 7%. This, although, is not going to impact your inflation. So, in order to check, to control, or to infuse liquidity, the monetary tools are used by RBI. And two of those tools I have already told you: the repo rate, the reverse repo rate, the bank rate, the marginal standing facility rate, and CRR and SLR. And of late, standing deposit facility rate has also been introduced by RBI, although we normally do not count it as a monetary tool, but it also helps in monetary operations. Standing deposit facility rate is the rate at which the RBI borrows from commercial banks, which is similar to reverse repo rate, but RBI normally never borrows. This is the rate at which the commercial banks can part their surplus funds with RBI, and the rate of interest paid by RBI on those deposits under standing deposit facility, that rate is known as standing deposit facility rate. And above all, when RBI doesn't want to use any one of these monetary tools, RBI uses open market operations. And many a times, particularly the young bankers, do not understand what is open market operations. The concept is very simple. Open market operations means buying and selling of government securities in the open market. Normally, when RBI buys or sells government securities, it is done by RBI in the captive market. So you have to understand the captive market also. And what is captive market? Captive market is the commercial banks who normally purchases or sells government securities from and to RBI. So captive market means the selective buyers or selective sellers. But open market means it is open to the public. So when government securities are bought and sold by RBI in the open market, that is also one of the monetary tools in order to maneuver the liquidity in the economy or liquidity in the system. There is one more important aspect in the monetary policy which my young bankers normally do not understand, is the stance of the policy. The policy stance can be hawkish, can be dovish, can be neutral, can be accommodative, or can be withdrawal of the accommodation. What all this mean to us? Hawkish when the policy rates are hiked, increased by RBI in order to keep the inflation under control and in order to bring price stabilization in the economy. And reverse to it when the liquidity is infused in the system, the tendency of the inflation is normally it goes up. And in case the liquidity from the system is absorbed, sucked out, then the tendency of the inflation is to come down. So these monetary tools which I have talked about it and these instances are very important. To instance, at present, under monetary policy, even in the review of yesterday, policy review of yesterday, it has not been changed. The instance says the withdrawal of the accommodation. But what do we mean by withdrawal of the accommodation or accommodative stance? It means that as and when required, the liquidity can be infused or absorbed from the economy or from the system. I hope some of these concepts will be very clear to my banker fellows, particularly the young generation bankers. With these words, I conclude my video. I thank you very much. I make an earnest appeal to all of you to like and share my videos. Send me the beautiful comments and also subscribe to my YouTube channel. Thank you very much. I am signing off.